Performance, performance, performance. That's all anybody ever seems to talk about. However, it's just as important that we focus on risk and minimizing volatility. Most people believe that performance is how they should judge the success of their advisor or money manager. However, it's actually not performance, but volatility minimization that is the single most important determinant of success for retirees. Why is that? Well, it's because when you throw volatility into the mix, you're forced to take distributions in retirement in down years, which means you're selling low. And nobody makes money by buying high and selling low. In fact, when you have to pull money out of your investment accounts in retirement during a down market, that's one of the biggest things that can decimate your retirement savings. Look at the graph here. If we look at the one on top showing the distribution phase of retirement, this example uses a retiree at age 60 with a $1 million portfolio, withdrawing $54,000 a year and then increasing that by a 3% inflation rate year after year. I think it's very interesting here. You've got two different lines. The top one, the smooth line, is producing an annual rate of return of 8%, and the jagged line, that where you run out of money at age 83, is producing an annualized return of 9.1%. A normal person would think that the 9.1% return does better than the 8% return, right? Nope, not at all. When you add in the volatility, the 9.1% portfolio runs out of money before age 83, while the 8% portfolio with no volatility lasts forever. Now, the 8% is obviously hypothetical, because if there was an investment that would give me 8% with no volatility, I would put 100% of my money there. So it is hypothetical. But the point I want to communicate is that it is actually more important to minimize volatility than it is to perform when it comes to making sure your retirement savings last. So stop focusing so much on performance and understand that risk minimization is actually more important. It's not just about the headline return that you get. It's about risk-adjusted return. And the better your risk-adjusted return, the longer your money's going to last. Tony, when is the last time a prospective client came into the office to meet with you and asked you how well you minimize volatility?
Never.
Right.
Never about volatility. It's about what was your highest return? What is your highest gross returns that you get for your clients? That's all they worry about, is that gross return that you just talked about.
Why do you think they don't conceptually grasp the fact that volatility minimization is so important?
They think the higher return means a higher portfolio value.
As should anybody, right?
Yeah, it's just simple logic,
9.1
right?
should beat 8.
Right.
When has 9.1 ever not beaten 8?
Never.
In this one example. That's it, right?
Okay, all right.
So nobody understands really how important the volatility minimization is, and it is the most significant thing that can be done to a retiree's portfolio. Now, I understand if you're 25 years old and you've got 40 years until you enter that distribution phase, I get it. 9.1 is going to beat 8. It will. But for those people that are nearing retirement or already retired, the 8 is going to beat 9.1 100% of the time.
Right, and it comes to volatility. If your portfolio is down and you're taking money out of it, you're locking in losses.
Right.
It's that simple.
So what this really requires to be successful is a paradigm shift, right? When you're in those early years of saving money and trying to grow your portfolio, maybe up until you're 50, maybe up to 55, the primary focus is really on returns, performance, building a good asset allocation strategy so that you can make money in all kinds of markets. But what this requires is a paradigm shift. Once you hit 55 for sure, and you're maybe in the red zone of retirement, it's important that you shift from focusing on performance to focusing on volatility minimization. And as we've talked about before on this show, how do you really get volatility minimization? What is the best way for us to increase returns and minimize volatility over a long time frame.
It's diversification, Mark.
Diversification.
And it's non-correlating asset classes. Diversifying those. So having, REITs, having international but developed and emerging markets, having the domestic market, obviously that's done great over the last few years, but having a mixture of the large cap, the mid cap, the small cap. I can go on and on about that, but it's about having that diversified portfolio so that you can minimize risk, so that when one thing goes up, maybe this one doesn't go up as much, but when that high asset goes down, this one doesn't go down as much. We're, balancing out those returns.
Right. And when we talk about non-correlated asset classes, it's really just these different investment classes whereby when one goes up, the other one might be going down. There's no correlation between them going up or down, right? We've seen this several times over the last few years where U.S. stocks have gone up and emerging market stocks have gone down, or vice versa. So they don't correlate, and not everyone might understand this, because some people, they seem to believe that they can, they have a crystal ball, or that they can play Monday morning quarterback and only be in the asset classes that go up. Right. It doesn't work that way. You need to hold them all in a well-balanced mix, and there is a formula behind that madness, a formula which takes into consideration correlation, it takes into consideration average return, and it takes into consideration standard deviation, which is risk, to develop the most efficient portfolio strategy, portfolio combination possible, so that we can get the best risk-adjusted return possible.
Right, and understanding your research, I think, is really important. What if you're early to the dance? You're standing there by yourself.
Early's wrong.
It normally is.
Yeah.
It really is, because no one's perfect at time in the market.
Right.
So understanding your research and saying, international is supposed to outperform domestic. Not starting tomorrow.
And we're not getting out of domestic and going all in on international.
Exactly.
Right. We want to maintain a proper balance.
Exactly. It's all about the balance and staying to a system.
Right. So for all of our viewers out there, I think the most important takeaway here is stop focusing so much on performance. Start asking the right questions. When you're interviewing an investment advisor, stop asking about their performance. I want you to go in and I want you to ask, how are you going to minimize volatility in my portfolio? Because at the end of the day, that's really what's going to help you to get ahead, and that's what's going to help to make sure that your money lasts into perpetuity, or at least until as long as you, hopefully, still survive in this world. How well are you managing your wealth? Are you taking advantage of all opportunities that are available to you? Just as it makes sense to have regular physical checkups to make sure you're maintaining optimal health, it also makes sense to do a regular checkup on your financial situation. Our Wealthalize tool will provide you with that diagnostic. Simply complete our online questionnaire in under 15 minutes. Our proprietary software will analyze your investment strategy, tax situation, asset protection, estate planning, charitable giving, and your professional relationships. You'll immediately receive a score ranging from 0 to 100, which assesses your situation. Additionally, you'll receive a SWOT analysis, which identifies your strengths, weaknesses, opportunities, and threats that could impact your wealth management. Visit today, www.wealthalize.com.